right. Good morning, you magnificent melonhead. Happy Tuesday, everybody. It is Tuesday, September 20th, the first day of the Fed's Open Market Committee meeting. Tomorrow we have the all-important Jerome Powell press conferences coming in. When they get together and they decide our fate, consensus seems to be a 75 basis point rate hike is coming tomorrow. If they were going to do 100 basis points, they probably would have leaked it by now, which they haven't done. So I'm going to go ahead and I'm going to guess 75 is still what's coming. And we will see what develops there. We got a whole bunch of economic data over the last couple of days. And let's just say not much of it was good. We got a little bit out today. A little bit of housing data came in. Some was good, some was bad. So it's not all bad. I don't want to doom and gloom everything. But it's messy, folks. And there's not a lot of optimism out there right now. And with the Fed tightening and everything else going on in the world, it's just not a very good sign. Anyways, we are at 9:16. Let's just first let's say hello to Mish the Mod. Mish, how we doing today?
Oh, we are doing great. I am in the middle of nowhere, Nevada.
Nowhere, Nevada. All right.
Yeah.
And how are the good people of nowhere treating you?
Well, I've said it before, being out in the middle of nowhere, but I am currently in this place called Lovelock, Nevada, where the people tell me you got to go 70 miles to do anything, period.
Okay.
I had to cross a 50-mile desert just to get here.
Lovelock, Nevada. Sounds like a bad marriage that like you can't afford to get out of. There's very high-priced divorce lawyers in Lovelock. Anyway, that was my bad joke about the name of Lovelock. Anyways, let's see what's going on in the indexes.
Go ahead.
All right. The Dow is set to open down 227 right now, or 0.73%. Another bad day for the Dow. S&P down 30 points ahead of the open, or 0.78%. And the Nasdaq leading the way lower, down 96 or 0.8%. So another red day for stocks. Just seems like there's not a whole lot to look forward to in the stock market these days. Again, that big CPI print that we got last week, it kind of sealed this market's fate. But I just have to throw out there that word of caution that I've been mentioning. When the pessimism seems so overwhelming, when there's just no good news whatsoever, that's when the bear trade gets crowded, and that's when you can get these sudden bear market rallies. And we're kind of right around the point where 3 months ago we had something similar happen. So just keep that in the back of your mind, folks, despite all the doom and gloom, that could always happen. Anyways, taking a look at the commodities trade here, we've got gold right now is down a couple of bucks, or 0.22%, currently at $16.74. Silver at $19.23, down another 12 cents, or 0.62%. Inventories at the COMEX and the LBMA in gold and silver continue to bleed out, even though these prices remain stubbornly low. Keep your eye on both of those stories. I'm not sure when something is going to break, but if they keep draining these physical inventories, prices are going to have to rise at some point, although silver could go a lot lower between now and then, especially if we get that market-wide sell-off in stocks. So keep that in mind. It's not just about those COMEX numbers. The rest of the commodity space looks like it's a mixed bag. We've got oils under a little bit of pressure this morning, down another 65 cents. I've been trying to call that bottom in oil, and the charts just won't show it to me. Natural gas down a little bit, $7.71 per million BTUs. Gasoline at $2.48. And it looks like base metals are up pretty much across the board. Copper's a little weak this morning. U.S. wheat at $844. Watch those grain futures, folks. They are ticking up behind us right now. Corn at $6.81, up $3.75, and soybeans down a little bit, $6 this morning. So a mixed bag in the commodity space. Nothing too big happening here. In U.S. government bonds, though. Go ahead, Mish.
So the wheat, corn, and soy indexes are moving up a little because there's a Wall Street Journal article last week and today. Two different articles starting to talk about how we did not have the harvest we thought we did.
Yep, we haven't done a video about this, but we got the WASDE report, or the World Agricultural Supply and Demand Estimates from the Department of Agriculture. That came out about 2 weeks ago, maybe a week and a half ago. And there was pretty significant reduction in estimates for soybeans and for corn here in the States. And the wheat estimates have been pretty bad anyway. And while that's happening, you're also starting to have a little bit of pessimism is building up in markets that something might happen in the Black Sea, and all that progress that was made at the UN to bring more grain supplies from Ukraine into the market, that we may lose some of that as a certain Russian dictator gets increasingly more desperate as his military underperforms. And I can just sense it already. The Putin trolls are going to be all out in full force, telling me that it's all propaganda and that the Russians are being triumphant and victorious and all that other stuff. You guys are adorable. I just love when you do that. Anyways, feeds the algorithm. So go ahead, let me know those comments. You guys are adorable. Got to send a shout out to my man, the Dumb Money Media. Thank you very much, sir, for the super chat this morning and for the support of the channel. He says, I just dropped a silver hype vid if you guys are curious. Also, the J-Hole Symposium one was fun to make. I got a short one cooking for the FOMC too. All right, Dumb Money Media, the king of money. Thank you very much, sir. And we're looking forward to that. Folks, Dumb Money Media has his own channel out there, and he does hype videos. He's all about my favorite of the shinies, silver. So go and check those out. And thank you very much, Your Majesty, for the support of the channel. By the way, I'm very sorry for your loss since you are the king of money. I feel for you as the queen has recently passed. By the way, we're in like day 12 of the queen's funeral. And not to be insensitive or any of that, all right? But I spend a lot of time perusing the news. Like I comb through news all day, every day, looking for my next video idea and my next topic. I mean, I have to read so much news to be able to do this. And I am so freaking sick of that story. I cannot wait for it to go away. My scroll finger is getting tired from having to scroll past the royal funeral for the first 10 seconds of every website I visit all day long. It's getting old, and let's move on. Life goes on, folks. Let's move on. All right. Robin RC Models, Mr. Mike Binder, thank you, sir, very much for the super chat and support of the channel. He says, good morning, Jack and Mish. Good morning, sir. Everything is setting up for a complete disaster. I agree. You can now even borrow for a burger or pizza delivery and pay back later. It's crazy. Well, as the saying goes, I will gladly pay you, what is it, Tuesday for a hamburger today? So, hey, look, we've always been able to borrow for burgers and pizza. I could put it on a credit card at any time. I guess when we see the market is innovating and creating new and more creative ways to borrow in order to buy a burger or pizza, yeah, that's when you need to get worried. Why doesn't anybody have any cash? Why doesn't anybody have any money? And, those trends of people going into debt, those are only getting worse, folks. People keep going further and further into debt. The retail sales, they're still strong. They're still doing okay. But it's all on the card. It's all funny money. It's all credit. So it's not real economic activity. It's just something to keep in mind. That something's got to give some point very soon. Also, I got to send a shout out to Sage News Live, who was in the chat. Hello, Sage. Good to see you, sir. Check out Sage News Live channel. He is the king of logistics, folks. All right. I wanted to also mention U.S. government bonds. We've got, yields look like they are up across the board with the exception of the 1 month right now, sitting at 2.51. We got the 3-month Treasury. Took a big jump up last night. It's currently at 3.37. The 3-month is about to flip the 10-year Treasury. That is some serious inversion of the yield curve, folks, when the 3-month goes above the 10-year, especially when you consider the short end of the curve is being held down by that Fed funds rate, that overnight rate. That suppresses those short-term rates. So to see the 3-month climbing like that, there is a lot of pressure on the yield curve right now. Also, the 10-year Treasury at 3.56, we have now broken above that resistance level that I've been talking about for a couple of weeks now, that 3.48, the previous high from June 14th. We're now above that one. Also, the 1-year Treasury over 4%, 4.05. I mean, these short-term rates going up so much. This is the market telling us something bad is coming. Right? There is something bad, something economically very bad is about to happen. When you get an inversion this deep, what's the 2 to the 10 now? 40, 41 basis points? That is not good, folks. All right? And by the way, if you don't, go ahead, Mish.
I was going to say, with the 3-month last night, I texted Jack there really late at night because I caught it right before it clicked over to the new day, and it had gone up 26 basis points just the 3-month, and nobody else had moved. So there's some movement last night, some crazy movement last night, and everybody watched that 2-year to 10-year spread. The bigger that spread is, the worse it's going to get.
Right. And when there's that jump that Mish is talking about right there. I guess the let's do a line chart right here. And of course I got the text right before I fell asleep from Mish. Thank you, Mish. Thank you very much for that.
I'm here for you. I love that for you.
Mish is this big data sponge, and he reports back everything that he finds. But yeah, look at that big jump up. We were, around market close yesterday, we were 313, and then boom, 3.39 we spiked to, currently around 3.37. So big step up in the short-term rates. We didn't see a similar move in the 1 month, which is interesting. You'd expect to see the same thing in the 1 month, but again, the ultra short end of the curve is held down by that Fed funds rate. So, but when I see these spikes moving up the yield curve from the long dated stuff closer to the shorter dated stuff, that is something bad getting closer. And it keeps getting closer and closer and closer, like a wave moving up a string. Sooner or later, it's going to get to the end, and that's when the real interesting stuff happens. All right. I wanted to talk about this one. This is not the Nasdaq chart. Where are we at? The 10-year. Here we go. Because we're looking going back to about a year on the U.S. 10-year Treasury yield right now, currently at 3.56. Let me refresh this because this is Yahoo Finance. This isn't always the best indicator. But I had been mentioning that we had a double top pattern setting up here, and that we could see a reversal, that was one possible outcome, because the last time we got up around this high, let me set this to a daily so it's a little bit better of a chart on the daily. Here we go. See, here was June 14th. This was the last time that the Fed started QT, and then a few days later they had their 75 basis point rate hike, and yet in the following days yields declined pretty substantially for about a month and a half. And then now for the last month and a half, we've been reversing that trend, heading right back up to where we were, and we're kind of, at least until yesterday, we were right about the same point right before Powell goes and hikes again. So there was this possibility that we got a reversal, that this was a double top that played out and yields started heading lower. And I had mentioned that was a possibility of a sign that the pivot may be closer than we thought. Well, we broke above that resistance line yesterday, and it looks like we're heading higher today. So I'm not going to say that's off the table because it's still out there, but it is much, much less likely than it was yesterday. And it was kind of a long shot going into yesterday anyway. So it looks like yields are higher. I still don't have any short positions in the market open, but I'm probably going to start one now. Now that I'm seeing this chart break and yields heading higher, I might wait until after tomorrow just in case we get a sell the news, or I guess it would be a buy the news if you count bears selling their shorts, just in case we get a little bit of a rally off of JPOW tomorrow. I might wait. I'm not worried about missing the bus, though, because if you look, here is the Nasdaq right now. There's plenty of room below, folks. There is plenty of room below. Like, if I'm not worried about missing out on the short trade right now. Yeah, I could have got in and my shorts up here, but we were still in that bear market rally. Because where we're at right now, we're at some point, it looks like we're headed to retest that low from June, which puts us around 10,500, 10,600 on the Nasdaq. We're going to retest that level. If I miss that by a few hundred points, I'm not terribly worried. And if that level fails, then guess what? We're going all the way back to these lows from March of 2020. That is where we find our next support. So there is plenty of room below. I'm not in any big hurry to put these shorts on. I don't want to get burned by another bear market rally. Just going to wait a few more days. I'm being overly cautious right now. But again, in the grand scheme of things, I think this chart has only just now started to roll over. And look, if you zoom it out, let's go to like a max chart. Look, does it look like there is any shortage of room below? If you zoom this out, this is going back to 2009. I mean, if this really is the end of a 50-year debt bubble, then I'm not worried about resistance from a year ago, resistance 2 years ago. I'm thinking resistance from 10 years ago might be in play. So not in any hurry to put those trades on. All right. That being said, let's get into some of this economic data that we got over the last couple of weeks. I want to start with this one. I'm a little behind the curve on this. This actually came out on September 1st, but this is telling about the state of the economy. Productivity and costs in second quarter of 2022 revised. This came out on September 1st. Non-farm business sector labor productivity decreased by 4.1% in the second quarter of 22. All right. Now, what they're talking about, labor productivity, this is the dollar value, the economic activity produced for every hour of labor. Right? So it's not talking about how many widgets somebody performed, or it's not talking about it's straight up dollar value. All right. So across the country, on average, there was 4.1% less economic activity generated for every hour of person labor performed. Right? That's not good. All right. When productivity is going down, that is deflationary. One of the ways you can fight inflation, that's inflationary. One of the ways you can fight inflation is by productivity going up, right? If wages are rising, but people are producing more economic activity for those higher wages, then there's not really any inflation going on there. There's increases in productivity to accommodate it. At the same time, though, in this report, unit labor costs in the non-farm business sector increased by 10.2%. So not only are businesses getting less output per hour worked from their employees, but they're paying 10.2% more for it. Now, keep in mind that 10.2%, that's not just wages. The actual hourly compensation went up 5.7%. This is talking about labor costs, right? That's your wages, that's your insurance, that's your payroll taxes, everything that goes into paying somebody to work for you. So 4.1% less output, 10.2% more input. Add those up, 14.3%. That's actually pretty close to the actual rate of inflation, isn't it? What's the shadowstats.com number is somewhere around 16% right now. So it's kind of within a margin of error there. But this is not a good sign. And if you think about it, supply chain problems, delays, Mish, you mentioned you had a pretty good idea about what might be causing this. And I think you were right on the money when you mentioned it. Go ahead. What was that?
Yeah. So what we're seeing there is that people are working more but producing less. And what I'm seeing is that I hate to use the term quiet quitting because it's not quite right, but it is that people are producing less for working more because they're seeing that, over the last year, they busted their butt, did an extra 20 hours a week when Bob over there has been doing the same amount of time everyone else and got like almost the same raise. So we're seeing a disenfranchisement of workers, essentially.
Yeah. And, I'll be honest with you. And I know we're going to see this in the comments because a lot of people do it. And on me 10 years ago, I probably would have said the same thing. There's going to be those comments about how, oh, it's just millennials are lazy or Gen Zers don't work. Nobody's willing to work anymore. And don't get me wrong, I'm sure there is some of that happening. All right. But on this scale, to see a 4.1% national decrease with a corresponding increase, that's not just some people are lazy, right? Keep in mind the concept of the younger generation is lazy. That's not new. That's been around for thousands of years. Every generation has said the following generation is lazy. It's always been said. It's not new. All right. What I think is going on is people's cost of living is going up substantially. They're not getting anything else for it. The wage increases have been a fraction of the increase in their cost of living. And so people are not willing to burn the candle at both ends to do well in their job anymore because they don't get anything for it. Nobody, right? You get what you pay for. That applies everywhere in the economy, including labor, right? You get what you pay for. And if you're not paying for productivity, you're not going to get it. And, I've been saying wages have to go up. They've got to rise. And Jerome Powell, with his rate hikes, he's doing everything he can to prevent those wages from rising. Now that he's made his money in the stock market and the asset inflation has gone up, but now it's hurting them in the polls because consumer prices are going up. Well, the next thing to go up, it would be wages. That's how inflation works. It hits assets first, then consumer prices, and finally wages. When it gets to wages, all of a sudden it's a problem and they have to slam on the brakes. Well, don't be surprised when productivity drops. Sorry, you get what you pay for. You made everybody's life miserable with your money printing. You got rich off of it, Jay Powell, and you fed governors when you sold your stocks in August. Right? Remember to eliminate the appearance of any conflict of interest? Yeah, how ethical of you. And now they're about to take away the punch bowl and crash the economy. And they're like, why won't people work harder? Because there's nothing in it for them. Give them a reason to.
Well, this is
That's what
kind of
it.
how the lie flat thing started in China. They realized that there was nothing they could do to have a life, so they gave up.
Yep.
And this is our
Oh, it's
version.
not just lie flat. And in China, what do they call it now? Runology. Have you heard of that one in China?
Which one's Runology? Is that the one where they
It's
work for
the
a day and then don't work for 7?
No, it's the science of escaping China with your wealth.
Oh, I
Not
have
only
heard that. Yes.
not only is it lie flat in China, which was basically like refuse to work and just consume what the government provides and do nothing because there's there's no hope of getting ahead because the housing market was crashed. All your household wealth is in the housing market, and the developers took all your money and they didn't build you the house and they left, and now you're left with the mortgage payments. So just give up. But now there's the science of escaping China with your wealth intact. Now, China has very tight capital controls on how wealth is allowed to leave the country. It's one of the reasons why they banned Bitcoin, because Bitcoin is the easiest way to move wealth across invisible lines. Well, runology is this trend among particularly younger folks in China now. And it is the science of escaping that country with your wealth intact. Because right now, because of the tight capital controls, if you want to get out, if you want to leave, you pretty much have to leave everything you own behind. Anything that's worth anything, all your accounts and all of it. So, when the trend is how to escape your country with your money, that probably doesn't speak very highly of the state of your government, does it? I just
No,
don't
not
know.
at all.
Yeah, not
Hey,
at
you want to
all.
hit indexes? Market
Yeah,
open.
let's hit the indexes. It is 9:36 and markets are open. So let's see what's going on. Where did my window go? There it is. All right. Up. So I'm going to have to open up my other windows because I had the futures up. All right, the S&P is currently down 38 points or just about 1% at 3865. Let's see, what is the Dow at? The Dow is down almost 300, 289 at 30,729, coming up on that all important psychological level, down 0.93%. And the Nasdaq, aka the red-headed step index, what is the Nasdaq out? Hang on a second here, folks. I get mixed up with the futures and the actual index. All right, the Nasdaq sitting at 11,446, down 88 or 0.77%. So another red day in markets, not looking good for the indexes today. We'll see what happens over the next 48 hours. It is going to be an eventful couple of days because there's a lot going on. We will be live streaming Jerome Powell's press conference tomorrow starting at 2:15 p.m. Eastern Time. We'll come out and we'll start a couple of minutes ahead of Jay Powell. We'll be live streaming his whole press conference, the Q&A with reporters, and then I will give you my reaction immediately after that. Those are always a good time, so I'm looking forward to that. All right, moving
Hey, you
on
want
from
to?
there. What do we
Yeah,
got, Mitch?
so we're moving on. Let's check out bonds real quick. It looks like the 10-year made a move about 10 basis points.
Oh, yeah, look at that. 10-year up 2.74%, currently at 3.58. Looks like it's the longer end of the curve is making the bigger move right now. We've got the 7 years up 2.25, the 20 years up 2.3, the 30 years up 2.69. So somebody's buying the long end of the curve right now. You might call that well, no, not buying it. They're selling it. I'm sorry. When you see the yields rising, that's the price is falling. Somebody is selling the long end of the curve right now. The three
Yeah.
month up another 2%. 6 month up another 1%. Let's bring up the 10-year chart here and look at this. I got to refresh it because 3.58, was that right? Is that where we were at? Yep,
Yeah.
3.58.
3.58. Yep.
Yeah, so oh yeah. I'm gonna go out on a limb unless we get a real big drop in that 10-year yield today. It looks like this double top pattern is dead and that yields are heading higher. Not a good sign. Not a good sign for stocks to see that happening. Stocks like lower rates. Lower rates means easy access to borrow money, means you can borrow money and do buybacks, you can borrow money and pay dividends, cash burning companies can stay alive. Nope. Not with the 10-year at 3.58, you can't.
Well, I think this is beyond just a single country dumping stock or dumping bonds. 30 basis point move on any given year or any given duration is a lot of money.
Yep. Absolutely. Absolutely. And look at this since the start of the year. Like go all the way back to the start of 2021. I mean, we started the year January 3rd at 1.62. I mean, we've more than doubled the interest rate on the 10-year Treasury this month. This is liquidity disappearing. All right. The Fed stopped feeding easy money into the system. They tapered, and then they started draining money from the system with their QE. And then last week, they doubled the rate that they were draining money from the system when they doubled their QT. And all the while, they've been raising their short end of the curve, the overnight rate. All the while, they've been raising that. It's very tight. And, the Fed was the biggest buyer of U.S. Treasuries in the world by far. Nobody was even close. And now they're a net seller. And the economy is not filling that hole. So this, this is the water level is draining. The level in the pool is falling. All right. So bad things happen when that happens, when liquidity dries up. Watch those overnight rates. Watch that repo market. Watch that reverse repo market. There's still all that money sitting in there in the reverse repos. Let me bring that up real quick because this is something we need to watch for tomorrow. But what we need, for
I
whatever
don't think it's
reason,
going to be a 1,000-point day today, Aaron.
Are we seeing a 1,000-point day today?
Yeah, I don't think so. I think maybe a 500 day. I don't think we'll see 1,000 day. Obviously, we'll come back on live if we see 1,000 points. But
yep, we'll definitely go spontaneous live if we see that. I don't see the ingredients right now for a 1,000-point day. It's not to say something else couldn't happen. We're down 328 right now, but you're still talking another almost 700 points from here. So, hey, stranger things, right? Stranger things have happened. But back to what I was talking about a second ago, the reverse repo. This is $2.2 trillion of money that exists right now outside the financial system. It doesn't affect interest rates. It doesn't affect stocks. This is money that was printed in 2020, 2021, and it's just sitting out there in limbo. Think of this like inflation that's already happened, but it hasn't hit yet. All of this money. And the Fed can use this to address a liquidity crisis at any time if they stop paying the interest on it or if they take away this place to send money. And this is still sitting out there. And $2.2 trillion, this is a huge amount of money. If this money was not in the reverse repos, it would probably be in short-term treasuries, which would bid up the prices and drive down those interest rates. So this is the Fed's secret weapon here. If we were to suddenly see the Fed say tomorrow, we're going to raise rates, but we're not going to raise the reverse repo rate, or we're going to lower the reverse repo rate, that will have this money start draining back into the markets. Now, the reason why the Fed wouldn't do that is because that would be very inflationary, right? That's a desperate move by the Fed if you see them do that, right? And if you do see that, that's probably going to be your biggest sign that the pivot is coming. If you see this reverse repo start to drain, that is the market running out of liquidity and the Fed using up its cushion. Keep your eye on this reverse repo. Still sitting at $2.2 trillion. It's been pretty much flat since they started QT, right? January or June 15th was when they started QT, and we've just been going sideways ever since. So we will keep an eye on that one.
Hey, while we're in the subject, do you want to talk about what a no-bid bond auction is? Because I think that's going to become important as a definition soon.
So what a no-bid bond auction is, I want you to imagine you're in a room and everything around you is on fire, including the air, and there's a tsunami coming at you, and a meteor is about to hit right on top of your head, and somebody's got a gun pointed at you. Financially, that's what a no-bid bond auction would be. It would be economic Armageddon, all right, because U.S. Treasuries are the foundation of the financial system. They are the riskless asset. I don't think they're riskless, right? There's government risk, but as far as the financial system is concerned, the U.S. Treasury is the foundation of the financial system. All of your money in the bank that you think you have in the bank, you don't. All right? The Fed or the banks have loaned that out. And what they have held in reserve to protect you, supposedly, or to pay you back, the way the bank makes money is they put that money usually either into loans or into U.S. Treasuries or into mortgage-backed securities. But U.S. Treasuries is like their safety net. That's their reserves. So if those U.S. Treasuries were to go no bid at a bond auction, and by no bid, it just means there are no buyers, right? At some point, right, the government has to borrow money from somebody. Well, what if nobody is willing to buy those bonds? What if nobody has any money to lend to the government anymore. Then those bonds go no bid. And if that happens, their yields start to rise, right? Because the government needs money, so they start offering a higher price for the money, and a higher price, and a higher price. What is the price of money? The price of money is interest rates. All right. So the interest rate were to rise, it starts to blow out, right? It's almost like, think like GameStop stock in 2021, right? Like the interest rate just spikes higher. Well, remember, interest rates and bond prices are inversely correlated. So if you were to get a no bid bond auction and the interest rate were to blow out, that is the value of those bonds in the toilet. And those bonds is what your money is in if you have a bank account, if you have a money market fund, right? And every ETF, every hedge fund, every bank, every financial institution in the world has a massive reserve of U.S. Treasuries that would basically essentially go to near zero if that happened. Also, the U.S. government would effectively default because the way the U.S. government operates, they borrow money to pay off their existing debt. So that it would be financial Armageddon if that were to happen. I was that doomy enough for you? We interrupt your doom and gloom to bring you even more doom and gloom.
Well, no, the reason I said something is because there are a couple videos that have come out recently talking about no bids. And I think going ahead and defining it now is good because that is the ultimate lack of liquidity.
Yep. And you won't hear anybody in the Fed. They won't even mention it. They won't talk about it. You know, it's Bruno when it comes to finance. We do not talk about Bruno. All right. Because they won't talk about it in a press conference. They'll just say, we think we can engineer a soft landing, or, you know, we think we have the tools to address liquidity as the problems arise. All right. And look, I don't want to say like this is going to happen next week. All right. A no bid bond auction is highly unlikely in the short, even the medium term. And it won't just happen instantly. You'll see kind of what we're seeing now. You'll see interest rates will continue to rise significantly. And you'll probably see a blowout in overnight borrowing, i.e. the repo market first, kind of like we saw in 2019 in September with the repo madness, kind of like we saw right before Bear Stearns and Lehman collapsed. We saw blowouts in the repo market. The overnight lending rate tends to spot these problems first. I still think we'll see it there before we see it in a bond auction. But it's possible. It could happen, especially with the Fed draining liquidity.
And we're starting to see spiky bond yields too, and that's never a good sign. Right. When I say spiky, I mean 10, 15 basis point movements over an hour and then right back down. So we saw the Japanese yen and the Italian bonds doing this, and then they had issues, and then now we start getting a little spiky. So it's just something to keep an eye on.
Yep. And that was a good question. And again, you'll never hear the Fed talk about it. I have heard it mentioned a couple of times in some Twitter spaces and in a couple of other channels. And, you know, Bank of America, a lot of these large financial institutions, they are starting to sound the alarm bell on liquidity in the bond markets. Bank of America had a absolutely terrifying idea. They said the Federal Reserve no longer is performing its role as the lender of last resort, which means, like, say you get nobody is willing to buy the bonds. The Fed was always the one who would just print the money and buy the bonds. Well, the Fed is tightening right now. They can't do that. So Bank of America was saying a GSE or a government-sponsored enterprise, think Fannie Mae or Freddie Mac, for the sole purpose of buying bonds when nobody else would want to. So when I heard that, I was like, they want to create this other Fed, not quite the Federal Reserve. They don't control interest rates. They just buy bonds when nobody else will, which would basically be like the Department of Inflation. That's what Bank of America's big idea was. Create this giant government-owned, not bank, that will just print money and buy bonds whenever they want. I was like, well, we already have the Fed. What do we need that for? And they're saying, well, because the Fed is tightening right now and the Fed can't do that. I was like, well, what's the point of the Fed tightening if you're going to create this other thing that's just going to ease while that's going on? Now you're just doing the same stupid crap that the Europeans are doing right now. raising rates while printing euros. Brilliant. That was Bank of America's big idea. Hey, I just report it, folks. It's not my idea. Don't look at me.
Well, that is endless liquidity, but it's also endless printing.
Yeah, it's endless inflation is what that is. Institutionalized inflation, which, look, we already have institutionalized inflation. We don't need more of it. Anyway, terrible idea. Terrible idea. All right, I want to get to a couple more of these data points because we've been going for quite a while here. So I'm gonna blow through some of these stories. These are all just more of these cracks we see emerging in the markets. This was yesterday in Bloomberg. Home flipper Open Door hit with losses in echo of Zillow collapse. The company lost money on 42% of its August resales after it failed to anticipate the slide in housing demand. Open Door is one of those companies that they basically had some algorithm that would buy your house without even looking at it, and then they would flip it. And the problem is flipping houses, anybody who's ever done that before, like, it's not a business that scales. You can't scale up. You can't write software that flips houses. Flipping houses it's almost an art form, right? The renovations that goes into it and knowing the local market. You can't write software to do that. This is Silicon Valley arrogance at its worst, and it's blowing up in their face. They lost money on 42% of their sales last month. But that 42% number doesn't do it justice, because I wanted to read this line. The losses, which don't include fees charged to customers or expenses incurred in renovating and marketing homes, have been looming since the housing market turned suddenly in recent months. So the fact that they lost money on 42% of their resales, they're just talking about price, that the resale price was lower than the purchase price. They're not counting all the money they're spending to list, to market, and to renovate these houses. And anybody who's ever flipped a house before knows that's a huge freaking expense. You can't just say, oh, yeah, we're not counting all that. That's a massive amount of money. So this story is way worse than the headline, way worse. And I can't believe I had to read all the way down to the fourth freaking paragraph to get to a data point that important, that 42% of transactions at a loss doesn't even include expenses to list, market, and renovate the homes. So this just all these companies, Redfin, Zillow, Open Door, they're going belly up. All BlackRock, Blackstone, all these companies that put institutional money into buying residential retail real estate, it's going to blow up in their face. I mean, a lot of it was our money. It was our pensions. It was our retirements. But it's not going to end well. What do you got, Mish?
Well, I was just going to say the construction companies that are doing the work. Sorry, saying thank you to Bojo. So they're doing the work. They're not doing that work anymore because these people aren't doing the renovations, which further slows down the housing market.
Absolutely. And hey, their payrolls, they're not paying. If they're not working, they're not paying their guys. They're not paying their guys. They're not buying their materials, right? Economic slowdown. One might even say recessionary. I'd hate to get definition-y or definitive. I don't know. Are we allowed to say recession? Will that get my channel in trouble? I don't know. Moving on. More bad news. What was that, Mish?
We're about to hit that third quarter, so I think we're going to be okay.
Oh, yeah. Okay, so here we go. The NAHB, this one came out yesterday. That is the National Association of Home Builders. They have this housing market index, which measures the sentiment of home builders. Let me give you the definition of the data first. The index is based on a monthly survey of home builders, and they're asked to rate current sales of single-family homes and sales expectations for the next 6 months, and to rate the traffic of prospective buyers. So the scores are based on a scale where a number higher than 50 means the market is growing, lower than 50 means the market is contracting. Right? And the NAHB Housing Market Index yesterday came in at 46. And look what it's done over these last few months. I mean, we have been in steady decline since December. This is the rates rising. All right. If you were to line this chart up inversely with interest rates, you'll see the same thing. Right? As interest rates rise, the housing market is hurt. And here we go, right here. We had a little bit of a flat line here, but home builders, they're struggling with the supply lines. They're struggling with labor costs. They're struggling with energy costs. And then interest rates is killing their buyers. It's reducing traffic, people shopping for homes. So This is another economic data point that says bad things are coming in the housing market. All right, now we got another one. This came out just this morning. Building permits. Building permits in the U.S., a proxy for future construction, tumbled by 10% to an annual rate of 1.517 million in August of 2022. And look at that one. Look at the building permits versus last month. Just big step change down. And again, going all the way back to the start of the year, we've been in this downtrend. All right, so this means future prospects, people who are asking for permission to build a house next month, next year, or whatever, that number fell 10% last month. That's an annualized rate, by the way, year over year number. So there's another data point that says housing not looking so good. Now, this one was something of an oddity, and I'm still trying to figure this one out. But housing starts in the U.S. unexpectedly jumped 12.2% month over month to an annualized rate of 1.575 million in August. This data point just came out today. So this is like the one silver lining in all of this data is that we suddenly get a 12.2% month over month jump in housing starts. All right, so new projects, new construction. Now, maybe what we're seeing here, you see we had this big dip in July. Maybe we got a little bit of data reporting error or something like that going on that, now we're overcompensating for August. That's possible. But this number, I got to be honest with you, Mitch, this didn't really jive with everything else I was seeing about the housing market. So this one stands out as like an asterisk to me.
This number makes no sense to me. I've been sitting here trying to think about it for over an hour on what would cause this. And you're right. It could be a reporting error. It could also be last minute, last of the year push.
Yep.
I don't know. Yeah. So
it could also be builders,
really
just scrambling to get done as many projects as they can because they know the market is about to fall out and they're trying to make as much money as fast as they can while they can. Possible. I'm just grabbing at straws here because this number did not make sense to me at all. And housing starts refer to the number of new residential construction projects that have begun during any particular month. Estimates of housing starts include units and structures being totally rebuilt on an existing foundation. So if they gut it all the way down to the foundation, that counts.
A housing start is just someone moving a shovel of dirt. That doesn't mean they're actually building the house.
That's possible. Yeah, they're starting to build.
They're starting to build. Like, okay, the guys are out doing the foundations or they're out doing the frame for the foundation because there's a concrete shortage right now. So there's a couple different things out there.
So it looks like the biggest surge was in the Midwest and the South. Those regions, at least, those will be the ones that crash last, I guess. The Northeast, of course, is lagging behind. All right, so why all this bad data in the housing market, with the exception of housing starts? That was a good one. It comes down to this one. This is the 30-year fixed rate mortgage, right? And we hit 6.42% yesterday. 6.42% after starting the year. What were we? 3.2 to start the year. 3.29 we opened the year at. Now 6.27 or 6.42. That's like a 40% increase in the payment of the median price house. All right. You don't get any more house for your money, but your payment is 40% higher. Think about your current mortgage payment. If it were to go up 40%, could you afford your house? I'm guessing most people will say no to that. God bless you if you can afford a 40% spike in your mortgage payment. By the way, if you're a renter, you've probably seen a 40% spike in your shelter cost. So again, God bless you. This is the death of the housing market right here. This is what this is happening. I remember I did an interview with the Ninja and with Jim Lewis and Ivan over at Wall Street Silver. This was months ago, actually over a year ago. It was last summer. We were talking about a housing crash last summer and signs that we saw. And I remember I said, no, we don't have a housing crash coming yet. It comes down to affordability. It's not about how far the prices have come. It's not about what the interest rates are. It's about what the payments are. As long as the buyers can afford the payments, the market won't crash. Well, right now, new buyers cannot afford these payments. And that's why we're seeing all these declining prices in the open doors and the Zillow markets going. people are being priced out. The payments are too freaking high. Wages have not risen enough. They can't afford these higher interest rates. And so, if the interest rates keep going up, the payments keep going up, then the price of the house has to come down in order to find a buyer. That's why I think we are on the cusp of a housing crash. And if these rates keep going up, I've been saying for a while now that we need a wave of layoffs, that mass unemployment is the missing ingredient in a housing crash. Not if these prices keep going up, not if these interest rates keep going up. If these interest rates keep going up, there will be no buyers. Cash buyers only.
Well,
That's it.
Buyers have already started going down. There's an index, a 50 index, or above or below 50 index of traffic, and it's at 31. So buyer traffic is completely gone.
By the way, I mean, if your plan is to get into real estate after the market crashes, keep in mind you're going to be faced with these kind of payments. Unless you're a cash buyer, you're not going to be getting into anything because you're not going to be able to afford all this interest. And remember, Jerome Powell, he's been talking an awful lot about Paul Volcker. Go back and look what mortgage rates were during the Paul Volcker years. Not a good time to get into real estate, folks.
No, not going to be fun.
No. You're going to have a bad time, okay? All right. Let's changing gears here a little bit. We talked about the economic indicators. Just want to touch on what's going on in energy markets. This story came out yesterday. OPEC is now 3.6 million barrels per day below its oil production target. Now, this headline is a little bit misleading because oil production is on the rise, okay? The thing is, OPEC is telling us they're going to raise production by way more than they've been able to raise production. This is the supply chain. This is social unrest. This is wars, sanctions, all of these things interfering with the production of oil. And OPEC has been raising their targets by so many 100,000 barrels every month to offset the big reduction in output that they started during the unfortunate health situation of 2020. Well, they're almost done raising their production targets back to the pre-2020 levels, but their actual production is nowhere near that. How much? 3.6 million barrels per day. They were already 2.9 million barrels per day below their targets back in July. Now they're 3.6, which means OPEC Plus, which includes Russia and a few other countries, their production targets, they don't matter because it's a BS data point. It doesn't matter. It's what they're able to produce right now. And Russia and Nigeria were the two biggest laggards in the group as far as being able to meet the production levels. All right, Nigeria is the largest of the OPEC countries that was unable to meet their quotas, and Russia has been unable to meet its quota. 1.399 million barrels per day behind the quota for OPEC countries, and non-OPEC producers were more than 2 million barrels per day below their quota. So even though if I honestly had to tell you, from the economic perspective, I'd say Russia is pretty clearly coming out on top compared to Europe right now as far as this economic war that's going on. I think you can safely say that Russia is coming out on top of that. But at the same time, the sanctions are taking their toll on Russia's oil production. It's harder to pay them. It's harder for them to get paid. It's harder for them to buy parts. It's harder for them to buy equipment. It's harder for them to maintain their fields, right? This is taking its toll on Russia's oil production, right? So, but again, I just want to mention this is below target. The actual production is still rising, just not rising as much as they're telling us it's going to. And look, folks, I've been trying to find a bottom on this crude oil chart for a long time now, and I just don't have it yet. I'm seeing some support forming here, and I like the looks of that. I want to see this RSI move up. Let me increase the size here. I need to see this relative strength indicator moving up, and I am starting to see some encouraging, we'll say, curvature in the MACD. That's moving average convergence, divergence. So again, we are close to a bottom in oil, but we are not at a bottom in oil just yet. I really want to make this trade, but not until the technicals tell me it's time, and I just don't see it yet.
Where's the retest at? Is that looks like 75?
The actual we're above that. It went just below 80 for like a couple of minutes. It was below 80 a few days ago. but it
No, I'm
popped
saying
right
on the
back up.
next retest. I think it's going to retest again and then
Oh, the
bounce
next
like a trend.
support level below this, that's low 70s.
Okay.
Yeah. Yeah, right around 74, 75. It's probably where I draw. You want me to put that line in there? I'll put that
No,
line in
it's
there.
just I think it's due another bounce and then it's going to trampoline.
Yeah. If we break
That's my
below
guess.
this level, I'd say that's probably your next support. I don't think we're going to break below that level, but again, I'm not ready to make that call just yet. So that's oil. By the way, shout out to my Patreon supporters. Thank you guys for your support of the channel. We spent a lot of time talking about oil and looking at the oil charts in my Patreon Zoom calls, which is tomorrow at 7 p.m. We'll be doing my Patreon only Zoom call. We'll probably be talking about oil tomorrow. We're going to be talking a lot about Jerome Powell and whatever happens at the Fed. But looking forward to that. There is a link down in the description below. If you feel so inclined, you can check that out. And also on the energy topic, I got to mention this one. Germany closes in on a deal to nationalize gas giant Juniper. By the way, I heard a number 30 billion euros they may end up paying to nationalize this company. But the billions are just piling up on Juniper. First, it was 4 billion, then it was 9 billion. Now, and this is cumulative 4 plus 9. Now they're saying plus another 30. This company is just burning through euros right now. And the government is talking about printing 30 billion euros to buy this company, which right now is losing 100 million euros a day because of these higher gas prices in Europe. Right? And
it's not even
shocker,
cold
folks,
yet.
it's not even cold, and you cannot print natural gas. You can't print it. So all they're doing is they're moving risk. Nationalizing Juniper does not mean you can get through the winter. It just takes the risk from Juniper and the Juniper shareholders and the ratepayers who would have to pay that higher price, and it spreads that risk across the tax base. Now the taxpayers have that risk. So either you pay for it with inflation, you pay for it with your utility bills, or you pay for it with your taxes. Either way, you pay for it.
Well, I
Something to
think
keep
it's
in mind.
important to note here that this is just the German gas giant.
Oh, yeah.
You still have your French, your Spanish, your Italian, your Netherlands, your UK. Those start
And
adding up real fast.
supposedly Germany is also in talks with two other utilities right now to nationalize them as well. This is Europe moving further and further towards socialism. It's not going to end well. And speaking of Germany, hello, Mike. I hope you're doing well from Robin RC Models. He says, let's buy an empty mall and install solar panels in Alaska. Yeah, you get the sun doesn't shine for 30 days straight at some point in Alaska. So, yeah, good luck with those solar panels over there, Mike. Interestingly enough, you're talking about commercial real estate. I've been reading a lot about reshoring or onshoring, and it's basically the reversing of the last 20 years of outsourcing, companies bringing manufacturing back to the U.S. And we have an excess of commercial real estate here in the U.S. We have way too many offices. We have way too many stores. And now we're talking about having to make things again in this country. So if you can figure out a business model that can convert commercial real estate efficiently and effectively into industrial real estate and figure out a way around all the cockamamie zoning laws and all the NIMBYism that might pop up, man, you will make a lot of money doing that. It needs to happen. We have too much of this and not enough of that. They're not making any more land, folks. But if you can figure out a way to turn all of these strip malls and everything, and maybe solar panels is a factor there, Mike, because you're obviously going to need a power supply if you're going to convert a mini mall into an industrial facility. But we have a shortage of one and an excess of the other. Just throw them out there. But thank you very much, Mike. I appreciate the support of the channel, as always. And good luck this winter, brother. I don't know, man. You guys, it's not looking good for you folks over there in Europe with what's going on there. And speaking of that, this one came out. Was this yesterday this was released? Or just this morning? Germany's PPI, 45.84. That is the increase in producer prices. All right. If you do business in Germany, it costs you almost 46% more than it did a year ago right now. That is, by the way, what was the month over month number? It was like 7.5% month over month. You just
it was
cannot do
ridiculous.
business. You can't do business in this environment. It cannot be done. And, this I know they want to blame it on Putin, and look, Putin is not innocent. I don't like the guy, not in the least. But this comes down to 20 years of insane energy policy. And look, I tweeted out a video yesterday of these just stop oil idiots, people who are funded somehow by a charity here in the United States. I don't know how they get away with that. These idiots are still in control of energy policy. If you try to move a truck full of fuel, you have 25 of these schmucks sit down on the road and chain themselves there. They wear their little high-vis vests and they smile when they get their photo ops. And then some magistrate or some judge just lets them out a day later and they go back and do it again. And these people absolutely control the energy policy. And they're funded by, well, Aileen Getty, the heir of the Getty oil empire. So they're funded by oil money. I don't know. Something has to change. There needs to be a drastic shift. Right now, the Greenpeacers and the idiots and the imbeciles and the children are still in charge of energy policy. And you get this. And this is going to be a miserable existence for a whole continent full of people this year because of that. And we'll see. Are they going to double down on stupid, or is somebody finally going to push back against these people? Only time will tell. But good luck to you guys. Mike, all you guys over there in Europe, I feel for you guys. Hang in there. And again, if you want to know why, take a look at this chart. This is the spot price for natural gas over in Europe. Currently sitting, about 8 times what it was last year. The average spot price in Europe was around 10, 15 through 2019. There was some 20s. Now 182. And that's way down off its highs. Keep in mind, these spikes will continue. That market is totally illiquid and totally volatile. So by the end of this winter, who knows? And, I know they're going to tell you, oh, don't worry, the storage tanks are full. We think things can go well. The storage tanks don't matter anymore. If there's no flow in through the pipelines, the storage tanks will not last as long as they used to last. Right? That's like saying I have a savings. Well, if you don't have an income, eventually you're going to run out. All right? So the natural gas situation in Europe is not good. Those storage tanks, even if they're 100% full, by January, Europe is going to be out of gas. Sooner if we get a cold winter. So something's got to change there. And Europe has immense reserves of natural gas and oil, but they ban fracking. They don't allow any exploration, any production domestically. Why? Because idiots and children are in charge of the energy policy over there. I wish you guys luck. And I can't say we're much better here in the States because, well, that's a whole, don't even get me started there. Just an inch of inflation, just an inch. All right, folks, the last one I want to talk about before we take a trip through the indexes here is Bitcoin. When is Bitcoin going to bottom? All right, let me just go out and say I don't think Bitcoin has bottomed yet because Tether hasn't popped yet. All right, as long as Tether is still out there, Bitcoin hasn't bottomed. So I think there is still a big leg down in Bitcoin to come. I'm still long-term ultra bullish on Bitcoin in the long term. I still buy a little bit of Bitcoin every week. I use an app called Swan. I just dollar cost average in. There's an affiliate link down in the description below if you want to check that out. I pull my crypto off of the exchanges. I never leave my Bitcoin on the exchange. I put it in cold storage, and there it sits. But this article had some interesting points here that they're talking about the bottom, and they're looking at the halving cycle. And historically, most of Bitcoin's gains happen in the 18 months following a halving. And a halving is when the payouts to the miners get cut in half. It's an automated situation. It happens every so many blocks that are mined. There have been 3 halvings so far. So there have been 2 complete halving cycles. And the last 2 halvings, the bottom in Bitcoin, because the price always crashes about 18 months after the halving cycle, the bottom was 547 days after the halving in 2017. And 2015. It was 547 days after the 2015 halving, and it was, and 517 days after the 2018 halving. All right, and I got to stop clicking on this thing because it keeps taking me there. So the last 2 cycles, the bottom was 547 days after the halving, or 500 before the halving, or 517 days before the halving. So I'm really butchering this segment. Stay with me here, folks. Now, the reason I bring this up is because when is the next Bitcoin halving supposed to be? 547 days from now. So we're we're right in that range, or just entering that range of historically where Bitcoin has bottomed before its next halving cycle. All right. Now, I don't think Bitcoin has bottomed yet. I just want to say that until Tether pops, Bitcoin hasn't bottomed. But if you go by the previous cycles, the bottom happens between 547 and 517 days before the next halving, which that tells me Bitcoin will bottom in the next 30 days. And if Bitcoin isn't going to bottom until Tether pops, that tells me Tether could pop in the next 30 days. Kind of making some very loose dotted line connections here, so bear with me. But keep in mind this chart, the 10-year Treasury yield that we already talked about, yields going higher, and the prospects of liquidity crisis and yields blowing out. Because Bitcoin right now, because of all of these dirtbags that run these DeFi scams and the altcoins and the stable coins and Tether, right? Bitcoin is not behaving like it was meant to behave as an alternative currency store of value. Bitcoin, because of all of these scams that are all built on debt, Bitcoin is a derivative of the debt market. And this chart is the debt market dying. I'm not saying Bitcoin is going to die, but remember, Tether is basically a Ponzi scheme, or at least it's rumored to be, where they take the money that people use to buy tethers and they go out and they put it in the riskiest assets possible so they can make the most interest on it, and then they don't have to pay anything in interest. So Tether basically takes none of the risk and gets all of the rewards. So they put it in the riskiest, most dog poop debt imaginable to maximize their returns, and they don't take any of the losses if things don't go well. So with these interest rates rising, that means the risk to Tether and all the associated BS crypto scams that are out there is coming back. Remember, we had a couple of months since the Celsius and all those other DeFi scams, and since they all blew up. They last blew up, like May, June, early July timeframe, back when yields were up here, and that stopped when the yields started going down. Well, the yields are back up again, and I think those crypto defaults are going to start happening again. And look, the history tells us that Bitcoin bottoms some point in the next 30 days based on the timing until the next halving.
Well, I think on top of that, margin costs so much more now. It used to cost 1% to go on margin. Now it's over 7%. So that cost of doing business has gone up.
And what is margin? Margin is debt, right? That's debt. Cryptocurrency, because of the margin trading, because of the DeFi and the lending and the staking, it's all just fancy word salad for debt. So crypto in its current form is a derivative of the debt market, and the debt market is blowing up. And if you go by history, history tells us that will happen in the next 30 days. So just something to keep an eye on. I'm not saying it definitely will happen, but I found it very interesting that I read that article and right as we go into 547 days. I was very curious. All right. Let's take one last trip through the indexes, folks, shall we? Looks like the S&P is currently low and heading lower, down 49 points or 1.26%. The Dow is down 378 or 1.22%, heading lower. And the Nasdaq's doing all right compared to the other ones, down 0.9% or 106 points, although the Nasdaq is just off its lows right now. Looks like it might be heading higher in the ultra short term. We'll see if that holds out. And let's see one more time. The 10-year is at just under 3.57. So keep an eye on that one. All right, guys. It has been quite a morning. A lot going on. Let me just make sure I didn't miss anybody here. No, I did not. By the way, I got to send a shout out to I can't remember the guy's name, but Mr. Free, I missed your super chat in the last live stream. I apologize for that, sir. Didn't catch it in time, and we shut down. Anyways, guys, we're going to call it there. Again, thank you very much, everybody, for your super chats, for your support of the channel. Thank you to my Patreon supporters. I appreciate that, guys. Looking forward to talking with you on our Patreon Zoom call tomorrow at 7 p.m. We're going to have plenty to talk about after Jerome Powell's tomorrow. Link down in the description below if you feel so inclined. And, Mish, anything you want to add?
Well, as you know, if you can find me in the wild, I'll give you a mark dime. I'm currently in Lovelock, Nevada, the place where you lock in your love. And then I'm going to head east. And I think I'm going to camp out at the Salt Desert.
Wow. Camping out in the Salt Desert. So if you can find Mish, if you can wander the Salt Desert for 40 days and 40 nights and manage to find Mish, you get a shiny dime for your trouble. Sounds like a good deal to me, Mish. Has anybody found you yet?
No, no one has actually found me.
Nobody.
I got recognized, of course, in Spokane, but nobody out and about.
He's real easy to spot. He's the round silver coin with Baby Yoda's face on it. Really, you can pick him out in the crowd real easy.
Yeah.
All right, folks. I want to thank you very much for your time. And until next time, I'll see you tomorrow at 2:15 for Jerome Powell's press conference. We will be live streaming that right here. Until next time, live small and dream big.